Good evening. Today topic share market basic for beginners. I will tell you how to become rich. Close the door. Be fearful when others are greedy and be greedy when others are fearful. It means be prepared to invest in a down market and to exit in a up market. As per the philosophy of Warren Buffett, a successful investor in USA. And it is not important whether you are right or wrong, but it is important how much money you make when you are right and how much money you lose when you are in wrong. Because saving is an important part of financial planning. The money you save today may help you to live a better life tomorrow. But people do not understand how to invest their saving and when to invest their savings. It is individual choice whether you keep your money in savings account or in fixed deposits, whether you buy insurance plan or invest in a retirement plan like pension fund and a provident fund. But there is another avenue, that is market based investment like share and mutual funds. For people who want to create a long term wealth, investing in the share market is a great option. The share market remains a popular investment avenue in India. Once you choose a right share, you stand a good chance to generate attractive income in the long run. Therefore, it is important to know the basics, the fundamental of the share market before investing. Share market is a place where the share of different companies are listed and traded. This trading takes place via platform known as a stock exchange. India has a stock exchange like Bombay Stock Exchange, short name is BSE, National Stock Exchange, short name is NSE, Metropolitan Stock Exchange, National Commodity and Derivative Exchange, Multi Commodity Exchange. The stock market is regulated by the Security Exchange Board of India. Short name is SEBI. SEBI imposes regulation on the stock market to govern its working, build transparency and protect the interest of investors. And you know, there are 5,600 companies listed in Bombay Stock Exchange and there are 1,600 plus companies are listed in National Stock Exchange. Therefore, it is impossible and difficult to judge, to measure and to analyze each stock before investing. Therefore, it is important to learn how to use the stock market index. A stock market index helps to track the performance of a group of stocks. NIFTY is the index for the National Stock Exchange and SENSEX is the index for the Bombay Stock Exchange. NIFTY is prepared by taking 50 top companies listed under National Stock Exchange and BSE take top 30 companies to make SENSEX. And some example of index are Bank Nifty, Nifty Pharma, Nifty Metal, BSE Mid Cap. Stock market index can mirror the performance of the entire market or a particular segment. This makes it easier for the investor to compare specific share and see if these are moving with or against a particular index. Stock market index can also provide a sense of the current investor sentiment, which can be handy for traders and investors in the market. The stock market comprises two types of products, equity and derivative. The equity market deals with the stock of the company. When you buy a company stock, you gain part ownership of the company. The derivative market deals with future and option. Before investing in a stock market, you need to open trading accounts and demat accounts. A trading account helps to execute buy or sell in the markets, whereas the demat account stores the stock you purchase through trading accounts. For example, you purchase share through your trading account balance will be debited and the digital share certificate will be credited to your demat accounts. And when you sell the share certificate will be removed from your demat account and the sale proceeds will be credited to your trading accounts. And it is very simple to open a demat account. First, visit the official websites of the depository participants, that means broker. Then you must submit a copy of your PAN, Aadhaar, identity proof, address proof with your passport size photograph. And the next step is the in-person verification. The depository participant or broker will usually send a representative for verification, and after formalities are complete, you will receive a client ID, a demat account number, and a password. And after that, you can log in and start investing. Here are the few important share market tips. It is important to keep in mind the following tips before investing. And first one is understand share market basics. Before investing your money in stock market, it is important to know how the share market function. What is NSE, what is BSE, what is NIFTY and SENSEX, and what is the time of functioning of the stock market, what is the rules that drive the market, and what influence the stock price, what is trading and what is investing, and what is the impact of the economy, and what is the demand and supply, how demand and supply affects the share market, the share price up and down. And second one is set goal before investing. Goal based investment can help you to work towards achieving your financial goal, whether you want to short term investment or long term investments. If you want to short term investments, then you focus on the price fluctuation stock price fluctuation. And if you want to long term investments, then you could invest in blue chip companies as they brings good return in the long run. Third one is the management of the company. Before deciding to invest in a company's stock, examine the company's management in details. The management play an important role in the growth and future development. Fourth one is understand the business. Before selecting a share, ensure the business of that company. Invest in the business rather than in the company. This strategy helps to understand the future prospect and growth of a company, whether that company is a government company or a private company. And fifth one is debt equity ratio. The debt equity ratio of a company indicates the percentage of money that the company finances through its bank and shareholders. It is preferable to invest in companies which have a lower debt to equity ratio. Such companies tend to be more stable than those with a higher ratio. Normally, 1 is to 2 is good. Sixth is research and conduct due diligence. That means before investing in a share market, you have to conduct fundamental research and technical analysis. Fundamental analysis means analysis of balance sheet, profit loss account, and cash flow statements. Analyze the ratio, that is P ratio, price earning ratio, PB ratio, price to book value ratio, current ratio, debt equity ratio, and compare it one week with another week, 1 year, between 1 year and another year, and between 1 month and another month, to assess the competency of the share, to assess the competency of the management, to assess the growth. And seventh one is avoid a risky low price stock. Low price stock, also known as a penny stock, attract investors because they seem like bargains. A stock price does not provide any indication of how well it is likely to do. Instead, you should study its fundamental before investing. Check it with financial statement, debt equity ratio, recent earning, and other details. This will give you an idea of whether the company is stable or on the brink of collapse. Understand your risk tolerance. Risk tolerance is the ability to bear market fluctuation and their effect on the overall value of your investments. Whether a person has low or high risk tolerance may depend on their income, financial situation, investment portfolio, and expenses. A conservative investor with low risks may better served by investing in a stable large cap companies, while someone with high risk would look to mid cap and small cap. Ninth is diversify your investments. It means don't put all your eggs in one basket. You should avoid investing all your money in just one company, because if that company or the sector perform very poor, then your entire investment could be at a risk. Therefore, invest in a stock of different companies. So, if one sector or one company does not perform well, the sector and companies that do well can counter the adverse impacts. This helps spread your risk and reduce your losses. 10th is be careful about leverage. That means leverage means using borrowed fund to execute your stock market investments. Many traders invest in the stock market by borrowing funds from their broker. While leverage can help you to make bigger and potentially more profitable traders, they also carry some risks. Therefore, be careful about leverage. Next, do not buy based on rumors. One thing you should strictly avoid in the stock market is investing based on rumors. Even if your friends or relatives suggest the stock, please don't follow their advice blindly. First, conduct proper research into the stock before investing. Analyze the performance of that company and its growth aspects. Always remember, good stock offer good return. And define profit targets. Since stock market is unpredictable and volatile, no one can correctly time the market movements. Therefore, it is advisable to determine your exit price before investing in a particular share. Once you once your profit target is reached, close your position and book profits. Next, invest through reliable intermediary. You should open your demat account and trading account through a reliable broker. The broker who provide several value-added services, timely market research and reports, share market tips, and a responsive customer care service, so that your issues are resolved quickly and efficiently. Next, control your emotion. One of the biggest obstacles for stock market investor is the challenge of controlling their emotion. Emotional trading and investing often leads to illogical decision making. Next, use stop loss. If you are new to stock market, learn to trade using stop loss. A stop loss is a pre-decided target that you can place on an order to restrict losses beyond a point. Stop loss protect investors from incurring heavy losses. Next, assess point of entry and exit. To take advantage of share investment opportunities, it is very much important. Before investment, you should assess when you invest or buy the share of a particular company, and when you sell that share. This would help you to book profit when the price movement is in your favor. Next is monitoring portfolio. Once you have made some investment in the share market, start monitoring your portfolio. The stock market is dynamic in nature and the price of stock keep moving up and down. Therefore, it is important to track your investment regularly and exit the stock at the right time. Then how to pick stock for investment or trading? Investors and traders carry out thorough research and analysis before shortlisting any stock. They use two approaches, that is fundamental analysis and technical analysis. Fundamental analysis analyzes the study of fundamental of the company. That means study of a balance sheet, study of a profit and loss account, study of a cash flow statements to find out the P ratio, price earning ratio, book value, the ROC, a return on capital employed, a rate of return, free float capital, the what is the growth aspects and the management status, the business style and the debt structures. Check if it is likely to be profitable in future or not. The fundamental analysis reveals the overall health of the company. Therefore, it is useful for investors in determining whether the stock of the company is suitable for investment in the long run or not. And technical analysis, you find the study of a price and volume charts of the stock. This may reveal pattern and could help one to predict future price movements. Technical analysis is useful for short-term investors or traders who want to profit on the basis of a price movements. Why stock price fluctuates? Once share enter the secondary markets, remember their price are governed by the law of supply and demand. That means when supply is greater than demand, then price will be low, and when demand is greater than supply, then price will be high. For example, a large number of buyers, but there are few sellers. That means high demand and low supply. So in this case, the stock price will rise. And when there are a large number of sellers want to sell, but there are only a few buyers, it means supply is higher than demand. Therefore, the stock price decline. And third one is the news events. Economic announcement like a change in the repo rates, means bank rate increase that affect the cost of the loan for a company. This could affect the stock price, and several other factors like company performance, sector performance. This will affect the share price up and down. And last, you have a better idea of how the stock market function. If you want to learn stock market trading and investing, simply dive in and begin your stock market journey. But before you start, do the due diligence. Shortlist the stock you want to buy. Check the fundamentals and the technical analysis for price pattern. So this is all about the basic of the stock markets for beginners. Thank you for watching. Please like and subscribe, and good night.